And my next guest is a numbers guy, so we thought we'd talk to him about it. Please welcome to the show America's accountant, Dan Geltrude. Dan, quietly, over the last 4 or 5 weeks, I would say that when Ashley and I kind of set up the show every morning, once a week, this story pops up, and it keeps setting records. America's regional banks keep tapping into this fund, and it says to me that we're not getting the full story here.
Well, this reminds me of the TARP funds, right, that were available back during the financial crisis.
Good point.
So those were funds that were set up in terms of loans from the government to banks to make sure that they didn't get too far out over their skis when things were a bit tight in the banking industry. Now, I don't know the exact details related to what the differences are between the two programs, but they seem to be quite similar. Now, I have to tell you this. When TARP first came out back in 2008, 2009, I really wasn't crazy about the concept. However, it did serve its purpose in terms of all the funds that were lent out were repaid with interest, right? And the banks were able to survive a pretty significant crisis. So although there may be signs here, Scott, of problems, it did work out in the past.
Okay, well, hopefully that's a good judge of the future. But a couple of things maybe have changed since 2008, 2009. I think one of the bigger ones is that the government really is, they have no control over a sudden run on a bank. No bank, actually, in this day and age can handle a run because it used to be that you had to stand in line and you could maybe shut the bank down or whatever. Now it's all online, and you can't tell what bank is struggling or not. And all of a sudden, Monday morning they're fine, Wednesday afternoon they're not. I think that that's different. And also, I do know that, with what we've got going on with the interest rates and how Silicon Valley Bank went down because of that, they had a duration problem with their investments. That hasn't gone away, and we're still raising rates.
Well, that is the key right there, Scott, right? So what really caused this stress were the interest rates because, quite frankly, banks got caught in a situation where they were lending long-term at lower rates and were taking in deposits at higher rates. So that's the perfect storm that they got caught in. Now look, the regulators are the ones that are supposed to be going through these stress tests with banks to say, okay, in these hypotheticals, if you had interest rates rising, how would the bank perform? And if the bank would not perform well, then you have to make some changes related to your capital reserves and so on to make sure that the bank remains healthy. Now, I don't think that we had per se a problem in every bank. Of course we didn't, but there were absolutely regional banks that were probably teetering, and we didn't know about it. So I'm not so sure that the Fed let us know really all the problems that were out there because they feared a potential run on the banks.
Right, and I thought the triple barrel announcement that they came out on some Sunday afternoon, I don't have the exact date, but it definitely was in March, when you had the FDIC stand next to the Treasury, stand next to the Fed. That told me that, this is kind of serious here when you get up those big guns. And just so the viewers I'm going to dumb it down, and correct me if I'm wrong, Dan, but when these banks take in all these deposits, they have to do something with that money. So they all bought short-term treasuries, right, between, say, 3 years and 6 years duration. And when you buy a bond, if that bond goes up in value, that means interest rates came down. But as interest rates go up in value, bonds go down. And so what happened was, right, these banks invested the money by buying bonds. Those prices of those bonds that they owned in the short term did fall. Now, if they held them to maturity, it was going to be fine. But when folks want their money back, they have to get out of those bonds that they bought with that money. And all of a sudden, they have a big loss on the books. That's the problem.
That's exactly it. And what happens is you have your funds that are tied up, and you simply can't get to them to be able to pay for all the depositors who, you're right, don't show up at the doorstep, but simply get on their phone and start transferring money that, you know what, isn't there. So that's the real risk. And you're right when you said at the top of the discussion, the real danger that we have now from 2008 is that people had to physically go to the bank, and you could shut the doors if you had to.
Right.
In the world that we live in now, money moves at the speed of thought. So if you're thinking about moving your money, it's as easy as moving it. And that's where so many banks could really get in a lot of trouble, Scott.
And that's maybe why they're still using that fund, because they're not out of the woods yet, and we're still raising rates. And we're going to do it again this week. All right, that's awesome stuff. Thank you very much. I understand it now, so hopefully everybody else does. Dan Geltrude, America's Accountant, thanks for coming on.